Hi and welcome. I am going to give you the lowdown that you need to know about how to protect your equity compensation before, during, and after marriage. I'm Dina Haddad, divorce attorney and mediator here in California through Families First Mediation and founder of The Complete Divorce, an online do-it-yourself tool using AI in order to help people achieve a divorce without much legal fees or professional help. I have an LLM in ADR, which is mediation, and I am an attorney and licensed here in California. Well, join me today so that I can help you know how to protect your assets in a manner that matches your values. So the first thing you need to know is, what does California law do for me, right? Why does it matter to understand California law as it applies to me if I am a resident of California? Now, keep in mind, these rules will apply to you even if you have only been living in California for 6 months. You become a resident of California. So that means even if you are not married in California, you're married in another state or country, California rules will apply when it comes to a divorce. So laws are important. As you know, there are many people who need the law in order for a sense of fairness or fairness to even apply in their case, right? But absent an agreement, you have limited options if California law is going to be imposed into your family life. So this is about people who are headed towards divorce, and now California rules are going to apply. If you don't do something, those rules will apply to you. Now, one of the biggest places that this is problematic is equity compensation. It's one of the largest marital assets when you have one spouse or even both working in tech. Equity compensation is payment of income, really, in the form of RSUs, PSUs, stock options, anything that comes in that form of stock instead of cash. Now, when you have such assets and you are headed into a divorce, just realize there's a huge set of rules that are complicated in family law and can be really hard for the parties to execute. I'm going to get into that, but it's an important concept because if you don't pre-handle this thing and you are in a complicated divorce later, you could be signing yourself up for really high attorney fees and a long protracted divorce battle. So what is important here is that your financial planning, the values that you have and share with your spouse, are important. So you want to really understand what it is that California believes it's fair and how that these laws apply to you so that you can decide if that's good for you, if it's a problem for you, and what is the alternative for you. Some couples, for example, do not intermingle their assets when they're married, right? I have my account, you have your account, you pay this portion of expenses, I pay this portion of expenses. My retirement is my own name, my employee benefit account is just in my name. And therefore, when we get a divorce, we each take our own things. But that agreement is just not enough in California. California would not follow that agreement if you were before a judge. You have to have a prenup or a postnup that is written and meets California's rules for prenups and postnups for that agreement to stand. Now, if you and your spouse end up in a divorce situation and agree to keep to that agreement, that's fine. But sometimes it doesn't go the exact way that the parties intended. So what are California's property rules? What is the base playground that we are on, right? What are the rules? What are the frameworks so that you can start to decide what you need to do? Okay. Number one is, how do they decide who gets what? There are two kinds of property. There's separate property, and I'm going to put those both up here, and community property. I want you to think of them as box 1 and box 2. Box 1 is all the stuff that you had prior to marriage. And if you're not married yet, it's all the stuff that you have right now. This includes your assets and income, your vested RSUs, maybe vested options that are not exercised, stock, brokerage accounts, ESPP, all the things, right? Anything that you had prior to marriage, retirement contributions prior to marriage, and so forth. Box 2 is community property. Community property is a 50-50 split of the assets earned while married. Okay. Now, a lot of people misunderstand this. They think the moment that they get married, the separate gets converted to community or some magical thing like this. It's not the case, but it is very difficult to keep your things separated while married. You have to prove it in the situation of divorce. Okay. So, in other words, I've got $100,000 in a separate bank account, good amount of money, and we get married. If I take that money and I start using it for groceries, it's gone. It is not reimbursable to me. That separate money is gone. I take that separate money, I put it in a down payment for a home. I might be able to get a reimbursement, the house down payment. The house is in joint name. This mixing of assets, which is very common in a divorce, is difficult. Simple things that were already your separate property prior to marriage. Now, very common ones are things like retirement accounts. You think of stock brokerage accounts, super simple, common assets that people have now that they're getting married later in life, especially if you think of second marriages. Okay, so if I have a retirement account prior to marriage, separate property. I get married, I don't tell my employer, hey, I'm getting married, open up a new 401k for me. I am going to be contributing to that 401k while married. Bucket one prior to marriage and bucket two while married. Now, here's the problem. How do you divide between those two kinds of monies later? Maybe you're going to get a divorce, God forbid, right? 10, 15 years later. But imagine that situation for someone. So now they have to prove what was there prior to the date of marriage. Hopefully they have a statement to show it. But what was the rate of return on that money since the date of marriage to the time that they are going to separate? So you do get the value of it over time, but you have to prove it. You have to trace it. You have to show it. There's so many ways that you can prove your separate property. But I just want to show you the mechanics to actually prove what you had prior to marriage can be complicated, even for simple things that you would have said, but we knew that that was my separate. But you need a starting place and you need a spouse that is agreeable to say that that's your separate property. That's box one. That's 100% yours. If you don't, you're left against California's rules, which say if you can't prove it, then it's going to be divided between the couple. So what does California do with equity compensation? What are the rules? So we talked about, generally speaking, separate property is prior to marriage, gifts and inheritance at any time. Community property is 50-50. That's everything that you earn while married, everything you incur as a debt while married, for the most part, right? And so now, where does stock and stock grants fall in? So equity compensation, as you see here, includes RSUs, PSUs, stock options, forms of compensation from your employer that is not cash. So this, again, extends to all sorts of things. California has a rule on all of it. They have a rule for privately held. I mean, they apply the rule for privately held shares, publicly held stock options that are not even exercised, vested. These options are like paper and they don't have any value. Therefore, I'm not going to share it. You can share paper, right? You can share the value of nothing. Each person gets half of zero. So this is an important element here for people who think that they don't have anything, but there may be something there that can later become a valuable asset. It's still considered community property. So again, as equity, another form of compensating, it's part of the formula for family law. So the court sees this both as an asset and as income, and they see it both as community and separate. So I'm going to talk to you today about how the courts will decide who gets what. So you may have heard a little bit about, I'm going to put a little bit more on here so I can talk about these and kind of get you up to speed about how the courts determine what is community property and what is separate property. There is a concept that the stock is being earned because of my efforts. And if the efforts are for my past performance versus my future performance, will weigh how much of those shares are community and how much are separate. However, the way that most equity is being awarded to people, especially RSUs, those are going to be under something called the Nelson formula. In fact, there's also some professionals who will apply, and forensic accountants who are CPAs trained in family law that can go before a court, that there's a reverse Nelson rule, which I'll explain later, but can apply to grants that were awarded to you prior to marriage. And then the shares while married will have some community interest, even though the grant was given prior to the date of marriage. Now, these formulas are a time rule formula. They create a percentage of separate and a percentage of community property on shares as they vest, depending on life events. In other words, just because I get grants while before marriage, it doesn't mean all the shares are going to be my separate property if I get married during the life of that grant. Conversely, if I get a grant while married, and then we get separated, and that grant still has shares that are vesting after our separation, those shares too can be considered community property. This is a huge dynamic. Most people don't realize this. They think that, only the shares that vested while married will have a community nature. Remember, community being divided equally between the two parties. The family court says the date of the grant has significance for earning community property through the life of the grant, even if the parties legally are separated. And date of separation is a legal concept. So when that date of separation happens, it does not stop the amount of community property being earned in these grants. It changes the formula for it, but the community can still earn shares post date of separation. So that's just from the asset side. Remember, we're talking about what are California rules? How are they going to be applied to my case? And what does that mean for me? So keep going. California doesn't stop there. And it's important to understand what else can happen. Now, if I have separate shares, and this is after separation, we are in a divorce, I am paying spousal support, or I am to receive spousal support and child support. The shares that I am getting that are separate, box 100% mine, are considered income for support purposes. In other words, those shares are mine, but the value of the shares is as if I'm getting income. It's part of my base or my bonus. It's shares that can be calculated in determining the amount of support I pay or an adjustment to the support I receive. Or if I'm the one receiving support, I'm receiving that in support by cash, not stock. And if I'm paying support, I might be paying it based on the value. This puts a lot of pressure sometimes on families who were saving the shares in order as like a form of savings and not as liquid cash. And now in order to pay the support, I'd have to sell the shares in order to make my support obligation. Of course, there are other options and ways to reach agreements between the spouses, but if you are without these options available to you with a willing spouse to negotiate these, you might be locked into California's rules. I want to really kind of explain this here, how this grant formula works, which is known as the Nelson formula, okay? So up here in this top left corner, you'll see there's a grant date, and down here you'll see the two significant life events that are happening. So you can assume here, let's just say we've got a couple, Matthew and Lucy, and they're married, and Matthew, let's make him my employee. So Matthew's got a grant that is awarded to him prior to marriage. And you can see here's a vesting and another vesting. And now he's getting married and they're happy and they're doing great. And no prenup, no postnup, no agreements, right? And so he has some additional vesting, another grant, some more vesting from both grants, another grant. And unfortunately, they decided, but it was mutual, that it's not working and they are going to get a divorce, data separation. These grants are still in full swing. So maybe this one has teetered off, but these two still have some more vesting dates happening. And then after the date of separation, Matthew gets another refresh grant and a few more here, right? Vesting. Okay. The way the Nelson formula would work is this. These are obviously his separate property. These, by the reverse Nelson, would have some form of community property. This grant will be mostly community property, even though there's some of them appearing over here after the date of separation. The closer to the date of separation, the more community property, the least likely that these will be community property. And this one will be separate property. But regardless, if Matthew is the higher earner, it will be considered income, those that are separate shares for support. If he is the lower earner, those could reduce the amount of support he receives. So even let's just imagine here, I'll just circle this one. If there are 20 shares and half are community, he would owe Lucy 5, right? 10 shares are community, 5 shares to Lucy, and the other 15 are his, 5 are community, and he pays support or adjusts his support based on the value of 10 shares. The Nelson formula divides the community estate pre-tax and says each spouse is responsible for their own taxes. It's not the way your employer works, right? IRS doesn't allow them to give you your shares pre-tax. Your shares need to come to you post-tax, just like your wages. So again, another place of burden that can happen to parties who are unknowing of the equity compensation rules when it comes to a divorce in family law. So what would happen is, let's just use my example again, the vesting is 20, and you are going to probably give up 5, 6 shares, depending on your effective tax rate, to the IRS. They're sold, they pay your taxes, and you get the net shares. The division of the shares starts on the top of that. So one of the things that people can do later, either in a prenup, postnup, if you do them pre-tax, you need to work with a CPA to transfer the tax liability from one party to the other. If you're doing them after tax, then the employee spouse is responsible for the taxes. The take-home message is this is complicated. And you may think if you were to get a divorce, it'd be easy. But these things can surprise you and actually will increase your fees. And it is to your benefit to pre-plan them out if you don't feel like this might necessarily be a fair approach. If it's fair, that is the way it should happen. Great. And it could be. Or you might want to tweak it a little bit with your spouse. And you definitely have that option at the time of divorce to reach those agreements with one another. Is ESPP. So this is employee stock. This is the idea of receiving stock at a discount, paying for stock at a discount through payroll. And the courts treat that as your decision, your intention to use your money for this form of savings from your income that is available for support. This can be really difficult post-separation because you may not have the cash flow to pay your support and continue in the ESPP program. So this might be another area that you would want to consider how to pre-plan for it. Also, the purchase of ESPP during marriage is considered community property. Cash in holding, money that you've put aside until the next ESPP purchase, would also be community property. The courts are looking at all forms and avenues of assets and income in order to achieve fairness between the couple. And that's really important, especially for a non-tax spouse, that they are also being compensated for the other person's efforts in the marriage. Because in family law, the idea of the marital unit is a financial partnership and that we are working together to achieve a certain lifestyle. So again, if that's not what you believe, then you need to work on a different agreement that you both believe is fair and is reflective of your values. Okay, keep going with me on this. I know it's complicated stuff, but hopefully you're following along. One more place. So in family law, there are 2 ways to look at the division of the party's estate. The first one is what we've been focusing on. That's assets. That's property. That's debts, right? That physical, tangible thing. I take 5 shares of stock. You take 5 shares of stock. I take the house and I buy you out on it with an interest. I take this retirement account. You take this retirement account. Yeah. Okay. There's another part, right? Which is when you get to support. And there are 2 forms of support. If you have children, there's child support. And if you're married, you have to deal with spousal support. By law, everyone has to pick an option. So how does the court determine support? Support is based on a number of factors, depending on which one we're talking about, child or spousal support. Again, I'll put a footnote here. There are plenty of videos on my channel to be able to fully explore this. But here I want to emphasize that the income that is calculated for people in tech includes their equity compensation. How can my shares also be income for support? Wouldn't that be double dipping? Not really, because the only shares that apply here are going to be your separate property shares. Okay, so using my formula again that we talked about before, you've got 20 shares, 10 of them are community, 5 and 5. So I have 10 that are my separate property. Those 10 are going to be income for support purposes. So the way that the court looks at it, if you have 10 shares of stock, they're $5 each. I owe $50 in, I have $50 in income that is available for support, just to use small numbers, right? So that becomes my income. So first I'm dividing shares as physical shares, 5 to you, 5 to me. Remember, we've got that tax mix up in there. And then the remainder amount goes in for income. And as you can see, bonuses count, commissions over time will count. Really anything that goes towards helping me pay an expense or making it easier for me to pay an expense. Okay. What do you do in this situation? If you are not married yet, you have the opportunity to sit with your spouse and with your significant other, because you're not married, and start to think about whether these rules should apply to you. You hear a lot about the gender gap between men and women when it comes to pay, child rearing, and other traditional roles. And those should not be excluded when you are thinking prenups. In fact, you can be creative with a prenup so that it's fair. But maybe the intention is for financial planning so that you have proper expectations. And in the worst situation, if you were to get a divorce, you have a game plan in place so that you are not left having to negotiate one of the hardest negotiations you'll be faced with at a time that is emotionally difficult and exhausting. You can always be more generous at the time of divorce, but you can never be less generous unless the other person agrees. So it's always nice to have the option or the opportunity to even consider whether a prenup. And if you do get a prenup, make sure you follow through. Make sure you understand it. You would do if you're saying, okay, we can buy a joint home together, but we're going to keep our income separate, keep it separate. We're going to have a joint bank account. We're going to jointly fund it. Make sure you do that. If you're going to keep retirement accounts separate, make sure you both contribute to retirement. There's not going to be spousal support. Make sure you get long-term disability or you properly fund, as I said, your retirement account. This is good for expectations, right? This is good because it allows parties an opportunity to really discuss some of these tough issues when the actual separation hasn't happened. There's more goodwill and good value in the beginning so that you can work these out. A prenup cannot deal with children issues, which is fair, right? You can't deal with child custody or child support. But as I noted, you can deal with spousal support and asset and debt division. You can be as creative as you like. You do not need to be cookie cutter, but you can, where you could say something like, everything is separate. We have no community property, and we want to keep everything separated. We're going to each be our own independent financial resource throughout the marriage, and then post-marriage if that happens. Okay, what happens if you're married? Well, during marriage, if you have a prenuptial agreement, keep following through with it. If you need to, you can amend your prenup while married to make sure it is up to date. Now, if you're married and you don't have a prenup, this is where you can do a postnuptial agreement. The postnuptial agreement is practically the same as a prenup, but here you can change the character of property because you've been married. You've probably assumed or created some community property. That's box 2. You're married, your income automatically becomes community property. So postnuptial agreements are more complicated in the sense that there is community property that the parties, the couple, has already acquired. And so that means the financial disclosures have a heightened requirement. You need to make sure that you've properly disclosed everything to one another, and you've done it all on the up and up. For both prenups and postnups, I highly recommend having at least a consulting attorney review the agreement with you. It's even better to do it via mediation, which we'll talk about later, but you never want to have a prenup or postnup, I don't think, done without the sign off of an attorney. It gives it the ability for enforcement. It shows understanding. It shows that you were given guidance before you entered this agreement. Okay. And what about at divorce, right? I didn't know this stuff. I wasn't prepared. We had nothing when we got married, and now we're here in divorce. What do we do? If you're without a prenup or a postnup and you are before the court and you have equity compensation, Nelson and the HUG formula are going to be applied. Like I said before, more than likely Nelson formula I showed you high level earlier in this talk. However, you can, and then for support, let's just hit this bullet. Separate equity, separate property shares can be considered income for support purposes. No prenup, no postnup. So important to consider non-confrontational, private settings like mediation that open the doors for creative solutions. The law is not always right for everybody. In fact, following certain rules make it more complicated for both parties into the future. And sometimes finding a creative solution not only helps both parties out, but it also just simplifies the process. When you mediate you can mediate or do private judging, collaborative practice, these kind of processes put the control back in your hands, even if you didn't have a prenup and postnup. I tell my parties, it is so important, not just to be cooperative in a mediation, but to be committed. If you are able to commit with your spouse to get to the right result, you will do just fine. It's good to know the law. It's good to know how it can be applied to you, but it doesn't mean that that's the only thing that is available to you. So to summarize, depending on where you are in your journey, what you think about California laws, how they match with your values and interests, you need to consider prenups and postnups. If you are headed towards a divorce, you want to start to think about how to engage the right professionals for yourself, how to make sure that your taxes are done properly, and then do your best to move towards more friendly divorce processes that will put you in control of the divorce option, because equity compensation is complicated. It can cost you a lot of money to negotiate these with attorneys, negotiate these in the courts, and the outcomes can be very formulaic. So you do yourself a favor by working with professionals, whether mediators, even attorneys, in a private, neutral setting in a way that you can reach agreements that take into consideration your reality, whether it's the high taxes, whether it's the ability of transferring shares, if they're private stock and that they are not easily transferable. There are so many nuances to know that you can actually do much better if you do work together with your spouse. Again, lots of videos on that topic, and I'm happy to share more. Thank you so much for watching. I enjoyed my time here with you. I'm glad you're tuning in. If you need to reach our office for services or have questions, make sure to drop a comment below, subscribe to the channels. Here's my business information. We'll always be able to follow me at Divorce with Dina, and we look forward to talking again.